Hey trader, Stephen Kwitzel here. It is Wednesday, July 31st. We're about, a few minutes away from the Fed making its decision. So, I'm going to go ahead and shoot this webinar because I typically don't make trading decisions just based on what the Fed does. I might just kind of wait for that day to see which way the market's going to go. But, by the end of this webinar, we'll kind of talk about that. I think it's kind of important though, when I'm recording this webinar during a Fed decision, to just keep in mind that, the Fed, whatever it decides, whichever way it goes, that's just fundamental reasons. I think it's best to wait for the technical picture to set up because, the Fed could cut and the market could like it or it couldn't. There's no sense speculating. I think it's just best just to wait and see which way, the wind wants to blow and go with it. So we'll just kind of keep an eye on that. By the way, please excuse my voice. I've been under the weather for several weeks now. My voice has been shot. So if it doesn't sound normal, that's why. Let's go ahead and get right into the Nasdaq. And I have some really, really interesting gold charts I want to show you today. But, the Nasdaq, it's really came straight off the bottom. And then we had a nice shakeout, a nice retracement. And now, we're at an all-time high. So wherever the market goes, I think it's fine. These pullbacks, these shakeouts, as I like to call it, they're very healthy and they're really just there to scare the hell out of everybody, right? So the market can resume its uptrend. So I think it's very important, when you have a shakeout like this, you got a big uptrend, then it just drops straight like 10% in a couple months. You think it's coming down here, and I was open to the possibility, but then I also talked about be prepared if it just surges right back and how to get back in. So I think trend following really is the best way to go. Have a specific set of rules where, it keeps you in your best performing stocks as long as possible and not trying to time what the market's going to do, what the Fed's going to do. But I drew these purple horizontal lines just to show you a lot of times what's going to happen is, right when we were around here, I remember saying, okay, I don't think the market is going to gun for here. I think the market is going to pick off the all-time high. And that's exactly what it did. And then it pulled back. So a lot of times what will happen is when the market hits a 52-week high or an all-time high, it sucks a lot of people in. That's not the best time to buy, right? Because what's going to happen is, look out, the market barely went up and then it pulled back. And now it hit another all-time high and we'll kind of wait and see. It's kind of acting squirrely. But, the Fed could push it one way or another. So we'll just kind of keep an eye. I drew this circle right here as a potential target one for a bounce. You get the 50-day moving average curling up. So if the Fed does knock it off its track a little bit, I think that's okay. I think even if it pulls down here, that's still a 50% retracement of this move. So the market's not going to go straight up, and you just have to be prepared, for whichever way it goes. But, we'll kind of see over the next coming days. But, we've really been following that rally line, that 20-day EMA, really closely. So eventually it's going to break, and I'm just going to kind of wait and see what it does. What I'm more interested in right now is the Russell 2000 because I'm looking at small caps. The S&P 500 chart looks the same as the Nasdaq, but I'm looking at a relative ratio of small caps versus the S&P 500, and this relative ratio chart has been in a downtrend, meaning it's been underperforming the S&P 500 for 12 months pretty consistently. Well, now we have another breakout, right? So it's not a definitive breakout, but, the Russell 2000 all of a sudden is looking strong the last couple weeks when the S&P 500 in the market has just been trying to figure out which way it wants to go. And that's why I don't look at the Russell 2000 for divergences and try to make decisions risk on, risk off. I've noticed too many times over the years, the Russell 2000 has a mind of its own. Small caps can. And a lot of that can, have to do with the strong dollar, the correlation it has, and the outperformance. So, and it's not always exact, but right now I see, okay, I'm kind of waiting for a definitive break, and then we'll see what happens, but the Russell 2000 small caps, it hasn't even came close, in my opinion, to getting its, 12-month high, right? It's just been in a very, very large consolidation. So you can make the bearish argument and say, well, it hasn't gone anywhere in 12 months. It's not even back to its 12-month high. That's pretty bearish. to me, I can also make the bullish argument and say, well, here's a big cup with handle, right? And if it breaks out of this handle and then this happens, that's a continuation of risk on. So, and I'm kind of looking at the bullish setup right here just because the longer, after bear markets, historically, you can have 2 to 3 to 4 years of really, really strong markets, right? The bear market shook everybody out. It scared everybody. It made everybody go conservative. And then you have a multi-year run of 25% average in the S&P 500. Doesn't mean it's going to happen every time, but historically speaking, after the bear market, you're better off being aggressive for a few years than trying to be conservative and waiting for that double dip. But right here, this is looking really, really interesting. If I go back to see what the market's doing, okay? So right here, you have a drop in the Nasdaq, the S&P 500 all of a sudden, and small cap is dropping, but it's still the strongest out of the bunch. So we'll just keep our eye on that, see, where the day closes after the Fed decision. And then we'll kind of go from there. So, and we'll probably have a decision by the end. So the Russell 2000, I'm keeping an eye on. I like it. This is a nice consolidation. Another thing while I'm looking for the bullish side of things, the longer this consolidation, the longer it's going to wear out investors. So they get impatient, right? And when you get impatient, when it is typically the time it's going to absolutely take off. So again, I'm looking at this and I'm saying, okay, this is kind of frustrating if you trade the small caps, but the longer this basis, the greater the chance I think of having a multi-year run. And, the market's pretty strong this year. Small caps aren't, but the overall market is, and I'm seeing this. So we still haven't had, we're entering August, September, which is historically, September is the worst month of the year. So I'm not necessarily going to play that. I'm anticipating, yes, the market can pull back. Yes, the traders can slam the market August and September. But until that happens, until I see it break down, I'm not going to use it as, a fundamental reason why I should or shouldn't be in the market. I'm going to follow my stocks, whatever they're doing. So just kind of keep that mentality, keep that mindset of, stay in as long as you can, because you don't want to miss something spectacular the next couple of years because you think the market's going to take a second leg down. So this is a chart of the US dollar. So by the way, it's looking like, see what happens? I'm just looking at the screen in the background and the Fed cut rates a quarter point and it shakes out and it can come right back. So it's best just to wait, see where the market settles. You can play some strangles or all that stuff, but let's go to the US dollar. I want to look at a weekly chart. We had from 2011 to 2015, 16, a pretty good run in the US dollar. Well, you could argue it's just in one giant consolidation. You could make the bullish, the bearish argument, but right now it's in an uptrend. All right. The 10-week is above the 40-week. It's in an uptrend and it's looking kind of strong. So it's just, I think, important to play this uptrend until this breaks or does something differently. When the 10-week is above the 40-week, you got the golden cross. You can argue the 50 above the 200-day. It's in an uptrend. Okay. So even though it's looked suspect, but the last month, it's kind of getting stronger. Now, it's important to keep in mind the correlations. You got right here a correlation chart versus the VEU, All World ex-US ETF. Historically speaking, if it's up here, it's positively correlated. If it's down here, it's negatively correlated. So usually a strong dollar, or they have inverse relationships. So a strong dollar typically means underperformance in international stocks and vice versa. Okay. So same thing with gold. Gold is negatively correlated because most of the price action is down here or since 2009. So 20 years. Negatively correlated. That historically means when the dollar goes up, gold's going to go down. However, in the last month or so, they've kind of been going together. You can see right here the correlation. And, you have these periods, and I think that's very important because I don't think it's a good strategy to play the dollar versus the gold day by day. Because if this chart tells us anything, it tells me they can be positively correlated for 6 to 8 to even 12 months at a time when you go back and look at history. So I think it's a bad strategy to say, you know, based on what the dollar's going to do today, I'm going to trade gold. I think that you need to look at history over time, but they're moving together right now. So we'll kind of have to wait and see it play out because this is a 20-year chart. But from, you know, October of last year to really the end of the year, so you had a 3-month stretch where they moved up and they moved up together. So just kind of keep that in mind. You have these pockets. Now, the dollar since the beginning of 2018 has been going up, okay? But it's still in a much, much wider consolidation. You could say the consolidation is broken and this was a downtrend, but either way, I show you this correlations. Now I have a very interesting gold chart, and this is one of my better charts of the day. So this is a chart of GLD, you know, the gold ETF. I think this is important to look at from a much longer picture. You know, it goes all the way back to 2005. So, you know, however long that is. Or I'm sorry, I think I call this a 20-year chart. This is a 10-year chart. So I'm going to go back to 2005, you know, which was a 14-year chart. But anyways, you had a major run in gold, GLD. Let's just say the GLD ETF. From 2005, it peaked in 2011. This run was up 350%. That's just an ETF, okay? It doesn't account for minors or options or leverage or anything special. That's just an ETF was up 347%. So commodities, they go in these just multi-year cycles that can last 5 to 20 years. Well, you know, when I look at this, I look at, okay, now it's starting to kind of climb the right side of a base that started in mid-2011. And I could draw a first stage rectangle box, you know, around this 130 to 100. And now it's breaking out. It's breaking through this level. So it's clearing some major ways, technically speaking, to get out of the right side of the base. Now, does this mean it's going to go straight into space? No. Right? I mean, look at this chart over here. You know, it went from 72 to 55. That's a pretty scary drop, right? But so you have some very scary pullbacks, you know, went from 100 to 68 along the way. But this was a major, major move that lasted, you know, 6-7 years. And then you have a major consolidation that's lasting about the same time. And now it's starting to clear technical hurdles. So when I go down here and I look at the RSI 14, okay, I'm not a huge RSI guy, but sometimes I look at it historically. So in a major bull market in gold, you can see that this RSI 14, it went into overbought territory, you know, for years and years, multiple times. So it stayed in this box. Never once did it dip into oversold territory in this multi-year run, okay? In a 6-7 year run. Well, then the tide turned, and then the box, it moved into a lower box. It might have poked above oversold for a second, but for the most part, it stayed down here, okay? So when I look at cycles, I say I'm looking for something that is, you know, changing personalities. I always talk about, you know, a stock, a cycle, an investment. Is it changing personalities, you know, from what it has been doing? And I think I can make the case for gold. It is 100% changing personalities, because now you went from oversold to overbought. Now we're staying up here. So how long does this last? I don't know. But if you look at history, it can last a couple years. It can last 7 years. And, you know, it's clearing this technical hurdle. Now it's clearing this technical hurdle. And when I couple that, I threw a Fibonacci retracement on this move. This pullback was right in between the 50 to 61% Fibonacci retracement level. So even though this is a very, very long-term chart, I mean, if you think about it, it didn't even get all the way to the 61.8% retracement level and is now coming back. So when you look at the big picture, this is a normal pullback and a normal consolidation. And I talk about when you're trading a stock and it's consolidating, it's pulling back and then it starts to round, right? It's kind of rounding second, rounding third, right in this area. Then you pick a pivot at the bottom in the middle of the base, like 131.15 right here. And when it crosses that, then you're in, because then it can, all these levels right here, this 174, 185, it's like a magnet. The price will be attracted. Will it go straight up? Absolutely not. Okay. I'm not telling you to get in right here and then it's going to go straight up to here. But, that's probably where it's naturally going to be attracted to. And then by the time it hits these levels, right, everyone's going to be talking about gold and everyone's going to be buying up here. That's probably the worst place to buy because it's going to shake you out. It's going to pick off these levels and then make a big, maybe 50% retracement of this move, right? And that's going to tick everybody off. So that's why I like to pick a pivot at the bottom of the base and then just take a stab at it and see what happens. I think when you have something like this where it's creating key or it's crossing key technical levels, like something simple like, okay, gold is extended. It went from 131 to 134.50. Maybe if I see a pullback and then I'll just pick a pivot like, 120, this pivot right here. And if it falls below this, I'm out. Like this whole technical setup could be wrong. I could be wrong, but it's hard to make the bearish case against gold, I think, long term. Next 5 to 10 years, looking at this chart. This is such a slow moving chart. This is barely, crossing this level and it's so slow. So, how do you play this? If you look at this move, right, and this is just a consolidation on the way to a continuation, that's one way to look at it. But you better have some time. Don't think you're going to get rich in the next year or two. But if it is a continuation, I think this right here proves that you don't have to be in individual mining stocks, for your account to be up a ton. You could just pick a spot on the chart like GDX, say, okay, GDX is way extended right now, but when I get a retracement, I'm going to buy it and then I'm going to look at, a pivot point to put a stop, right? And if it stops me out, I'll look at it again. It might come around, stop you out, and then come back and clear this pivot again. And if that happens, I'll probably buy it again. Because you have to think on something like this, it's going to try to stop you out multiple times along the way. That's why sometimes it's going to have some major gut check corrections if this whole thing works. That's why I think it makes sense to, try to pick a strategy, whatever your strategy is, that you can sit with, that you can live with, right? That you can hold. And, if this is halfway true, right? If it just continues to climb over the next couple of years, could take several years to get back to this level. I don't know. But, that's a pretty big move just for GLD. Miners would be up a lot more. So, with that being said, let's go down here to look at, the gold versus the GLD chart, right? So you have S&P 500 relative ratio versus GLD. So during this time frame, when gold was going up, S&P 500 was underperforming, right? And then it peaked right here. You can see, I can draw a vertical line, peaked right here, and then S&P 500 started outperforming. It's sitting on the line right now. I could make the argument that it broke right here, okay? But it's sitting on this line. You can see it blown up right here. If this line breaks, to me, that's just extra confirmation, right? This relative ratio chart right here, if this, 22.1 level breaks on this relative ratio chart, it could send this crashing down. And this is just a relative ratio chart, which could confirm this, which could confirm this, okay? Just be open to the idea of us being in a multi-year move of gold outperforming the S&P 500 for 5 to 7 years. I don't know. I have no idea. It could be 1, could be 7, could be 10. But I know these are some major technical spots on the chart that are starting to be broken. This is, I think, something to take very serious. And this is a major trend line that has been going on for the last 8-9 years. If that's broken, I will take it seriously. And I could argue it already broke, but it's not a definitive break. Could come back, right? Bounce, right? So the S&P 500 has bounced a lot, which is why this is going up this year. And then it could just boom. So all possibilities, okay? But the more I look at this chart, the more I say, I think you'd be not smart to just completely ignore this and avoid what's going on. Okay, so coming back, look at that shakeout right there. A nice shakeout in the overall market, and now it's coming back. That's why you sometimes just gotta kind of let it play out. So let's go look at some overall market breadth. You can kind of close these down. I think I made my case. So the market is in an uptrend, okay? 64% of the S&P 500 is above the 20-day moving average. You can see that technology right here, peaked back in July, over a month ago. So breadth is starting to weaken in technology. We're pretty close to an all-time high. Financials, although I've seen some strength in earnings lately, they're still strong, okay? But we gotta keep an eye on this, because if technology rolls over, I'm going to be looking for new leadership. Financials has been in a downtrend really for 12 months. A lot of money could pile in financials, but we'll just kind of have to wait and see. Maybe we see what it's doing here in a minute. So you have 55% in discretionary, 70% in industrial. So have a pocket of strength in industrial, which is good. That's aggressive. Healthcare, 67%. So a lot are very similar. 75% in staples. Energy was looking really weak, and I put an article about shorting oil, and it looked like some oil stocks were rolling over, and now all of a sudden the last couple of days, this week, they're kind of surging back. So false breakdown maybe could be an above average move to the other side. Have to be willing to change your position. I have no problem putting out an article about shorting oil, but if it doesn't break down and they go the other way, I'll immediately adjust it and say long oil. Like, you just have to be willing to bend a little bit. Materials is still strong, which makes sense. Gold stocks, utilities weak. Okay, I'm cool with that. So really have a mixed bag, but I think for the most part, breadth is still bullish, but it peaked before the price action of the overall market did. So the Nasdaq peaked last week, but the tech stock breadth peaked, 3-4 weeks ago. Okay? So until I don't really give this much attention, because this is a secondary indicator, until the price breaks, until the rally line breaks, then I'll say, okay, right? It's confirmed by the breadth, so I'll step out of the way, or, keep an eye on it. The percent of stocks in the S&P above the 200-day moving average, 72%. That's bullish. I'm not going to make the bearish case. That's bullish. I can make the case for a pullback, but, if I go back, let me go back to the S&P 500 weekly chart right here, just to make my case. And I've shown this chart several times. You had a double dip correction in 2015, 2016, one last shakeout, and then we just went on a major multi-year run. This chart looks a lot similar. Got a shakeout. We could be somewhere in here, right? Right here. And then just get that multi-year move. Same thing in 2011. You just had a nasty correction, bear market, whatever you want to call it. I think it was a bear market for small caps. But then it came out and it was a shakeout. Then there was a shakeout. Then boom, 2013, 2014. Just straight up. So when you're coming out of some really nasty stuff, it can really try to roll over a couple times, and then, it's going to scare you, it's going to shake you out, and then you just got these multi-year moves. So it's really best to, stay in as long as you can until you're proven otherwise. So let's see where the market is now. It's still getting sloppy. That's why I prefer to just kind of pay attention the next day or at the close. Okay, so, REITs, energy, utilities are up. Staples are down today. Let's just look at the last 1 week. REITs, starting to, there's some money piling into REITs in the last 1 week. Discretionary's down, technology's down. Okay, so those are the two I want up. Those are the two more aggressive sectors. But 1 week is not a trend. Because you can clearly see in the last 1 month that, the technology sector is the strongest. All right, technology dominates. Energy is the weakest. All right, it hasn't gone anywhere. But energy has honestly been weak for a long time. For a couple of years, it just really hasn't been strong. There will be a day where it's strong again. Just like there will be a day where gold just really runs. So it's important to, not fall asleep at the wheel. Let's go to the individual industries. Let's look at the last 1 week, kind of see where money's piling in. Toys, that's probably earnings related. So again, I want, the strongest stocks. This is the strongest sector. This is the strongest industry, right? So I want the strong stocks and the strongest industries and the strongest sector. I'm more interested to look at REITs right now to see where money is flowing into. Okay, so here's an excellent example of why you want to break down the energy sector and not buy an XLE. Because you can see coal's getting hammered, but renewables, there is just a ton of money piling in. Solar, stuff like that. Let's just investigate for just a second. Yeah, see, that's not really broad participation. My guess is these are earnings related. I could be wrong. Maybe that was bought out today. I don't know. I bet that's an earnings gap. Let's look at this one. Could be another earnings gap. They could emerge. I don't know. But that's not a ton of broad participation. I really like to see broad participation. Let's keep moving on. So even in the last week, I kind of want to go down to the REITs. So this is what I'm talking about when I say broad participation. If you look at some of these others, they have 1 or 2 green and a lot of red. And technology has 1 green and a lot of red. REITs, there's something going on here. 2% isn't exciting, but that's a lot of broad participation. So, we look at this. So I'm going to take one of the strongest industries and strong sectors, at least in the last week. Look at all that green. That's a lot more green than red. This is your honey hole. This is where you want to fish. At least investigate to see if you can find any early movers. I'm not going to buy something. It's already moved a ton. That's a thin stock. I should have probably looked at that before. All right. Transcontinental, let's just look at this. I'm just going to kind of look at the top few. Again, I should have volume on this. I've never heard of that. Maui. I wonder if this is another thin one. Yeah, these are just thin. So, a lot of thin, so I'm just kind of coming through here. But here's something that looks interesting. Brookfield Property Partners, this isn't a recommendation, but it went from 14 to 20, and then it pulled back, probably retraced to that 50% level. And, I talk about, you remember the gold chart, I talk about picking a spot on the chart as it's starting to climb the right side. So 1965, 1949, it's trying to clear this one today. It could pick it off, pull back, and do one last curl. That's probably one to investigate further. I'm kind of curious in this Invitation Homes. I'm familiar with this name. Yeah, this has already made a big move from 19 to 28. That's a little extended for me, so I'm not going to go back to that. Let me kind of look here. What is Howard Hughes? A lot of these names I don't know. Yeah, that's a little too wild for me, but I think that, REITs, if we kind of go back to the real estate, you can continue to look in these diversified REITs. Yeah, Essential Properties, this is one that looks interesting to me because, yeah, you can see right here, this one, I emailed this one out to everybody, or at least to my subscribers on Monday. It had a nice weekly reversal pattern right here. And now it's nice up, and then kind of you get a little double bottom, a little consolidation, nice weekly reversal pattern, undercuts the previous week, and then boom, now it takes off. This is probably the one I should have bought. But, that's that's not a bad place to look. Let's look at this one. Yeah, this one has already made a big move, but that one's pretty thin. So I'm just kind of continuing to kind of go through some of these and see what they look like. Let me kind of look at the weekly chart on this one. Pretty nice uptrend, kind of some nasty selling. It's not a weekly reversal pattern. It did come down to the 40-week, but got some distribution in there. So, I mean, I think EPRT, I mean, that clearly is the stronger one of the two. So I think REITs is just continue to kind of go through some of these and see if any setups are worth your liking. EPRT is not a bad one to put on your watch list. And I hope this was helpful.